Now, without further ado, we've got Ryan Watkins from Messari.
All right. Thank you, Ryan. And I'm Ryan Watkins. I'm a research analyst at Messari, where I cover currencies and stablecoins. And today I'll be giving you guys an overview of the state of CeFi. So what is CeFi? So CeFi is short for centralized finance, but I like to use it as a catch-all for all of the centralized institutions that sit between the world of fiat currencies and cryptocurrencies. So why does that matter? So you think about, what are these different institutions that sit between these two worlds, and what do they do? So you have exchanges like Coinbase that provide fiat to crypto. You have custodians that custody crypto. You have different financial services firms like BlockFi that are lenders. You have stablecoin issuers. And the gist of why these institutions matter is because they are the way that value moves to and from cryptocurrencies, which as we try to grow this space, they are the critical institutions to enable this transition. So one of the biggest trends that we've seen really over the past couple of years, and especially over the past few months, is this kind of race to become a full service crypto financial institution. So what does that mean? So basically the line between different service providers is kind of blurring as all these different firms dip their toes into different verticals outside their primary line of business. So on the left side of the screen, you kind of have a select group of representative companies that dominate specific verticals. You have Coinbase, which is a fiat to crypto exchange. You have Binance, which is a crypto to crypto exchange, backed a regulated institutional derivatives exchange. FTX, which is a retail derivative exchange. BlockFi, a lender. Coinlist, a capital markets firm or capital raising firm. BitCo, a custodian, and Genesis, a trading firm. So if you look kind of like at all these different verticals that all these companies that are in, it's almost difficult to get a sense of where any of these companies began, because they're all in so many different businesses now that it's almost not clear. So you have Coinbase that's now in payments and institutional trading, especially with this recent acquisition of Tagomi. You have FTX that's now launching a spot crypto exchange in the United States. BlockFi, which launched an exchange, even though it started as a lender. Coinlist, which also has an exchange. Genesis, which is now getting into lending and custody. And the big picture here is that while many of these different verticals are dominated by single players today, the market is just very small, and all of the opportunities still exist on all of the participants and individuals and firms that have yet to come into cryptocurrency. So that's what everyone is trying to position themselves for. So basically, when you're going into a new line of business, you basically have one of two options. It's buy or build. And while we've definitely seen a lot of build, and it's been touched on in some of the previous panels we've seen today, we're also seeing a lot of buy. And in 2020, we've seen already 3 of the largest acquisitions in this industry's short history. Number 1 being Binance and CoinMarketCap, which is tied for the largest ever. Backed and Bridge 2, which is also this year, and then most recently Coinbase and Tagomi. And in the prime brokerage space specifically, you kind of see this on the right side of the page. We've seen a pretty, over the past month, we've seen 3 pretty big announcements in that space as people try to build the prime broker for cryptocurrency. So another big trend that we're seeing in CeFi. So like I mentioned, one of the major institutions that sits between fiat currencies and cryptocurrencies are stablecoin issuers. And they're quite literally putting dollars on a blockchain, right? So what these firms do is they basically take dollar deposits and issue IOUs on a blockchain, which we refer to as crypto dollars. And these crypto dollars have exploded in 2020. You kind of see this on the left side of the chart. At the start of the year, around just under 6 billion stablecoins issued, and now approaching 11 billion alone. And most of the growth actually occurred after March, when we had that very big risk-off event that sent investors searching for kind of a safe haven from the volatility we're seeing, not only in cryptocurrency markets, but more broadly financial markets in general. But it's not just that these crypto dollars are being used to store value. They're also being used to transfer volume as well. And there's some good panels earlier that kind of described the wide variety of use cases. But kind of just zooming out on how much economic activity are these crypto dollars actually producing, and it's here quintessential hockey stick up and to the right. And in the past 12 months, currently crypto dollars have transferred just over $350 billion. So they're a significant currency on public blockchains, and on Ethereum alone, actually, where the majority of them are issued, they account for about 80% of the total transaction volume on Ethereum. So like I mentioned, a lot of this volatility was it caused people to want to shield themselves and go into stablecoins, but you think about who really benefits the most from increased activity, really at least increased trading activity, and it's the exchanges. So think like exchanges are by far the largest profit centers in crypto. They produce the most unicorns in the space and the majority of unicorns in the space. And in 2020, they've seen some of their highest volumes ever, really only having been eclipsed in 2019, when we saw Bitcoin run up from 3,000 to 13,000, and the infamous 2017 bull run. The same could be true across the cryptocurrency derivatives exchange as well, which also are seeing some of their highest volumes as well. So kind of zooming in on the cryptocurrency derivative space is CME. So CME launched their Bitcoin futures actually about 2 or so years ago in December of 2017. But what's particularly interesting about them now is that they're kind of this really good barometer of institutional interest in the asset class, particularly Bitcoin. And it's because many of these institutional investors, it's the easiest way for them to get exposure to Bitcoin, through this regulated institution. And what's interesting is that while it was unclear how institutions would react after cryptocurrency's infamous Black Thursday that saw Bitcoin drop as much as 50% in a day. It's been interesting to see that not only has open interest kind of recovered from then, but has actually risen to its highest levels ever. And you see both in Bitcoin futures and the Bitcoin options, open interest at its all-time highs. And the same trend could be seen across Grayscale as well, across their trust products. And over the past 5 months in 2020, we estimate that Grayscale has seen about over $800 million in inflows into their GPTC product alone. So they're a very large buyer of Bitcoin, particularly new Bitcoin. But probably a little bit less so than people would believe. So there's this, nuance here with the way that GPTC shares are created, where you can either create new shares by purchasing them with cash, in which case, Grayscale would go in, take that cash and buy Bitcoin and put it into trust, or you can go in, borrow Bitcoin and create shares with that borrow Bitcoin. And the difference is that in Q3, which is the last time that Grayscale reported this kind of in-kind purchase, it was about 80% of all of the contributions into the trust. And the reason why these basically hedge funds are doing this is because there's usually a very large premium for the GPTC products above its underlying basket of Bitcoins. So a lot of them are playing the ARB, and when you factor in those in-kind contributions, it actually lowers the amount of Bitcoins that they are actually buying. So what's the catalyst for all these inflows, the increased exchange volume, this race to build this full service crypto financial institution? Why is this all happening? And I think most people following this space have been pretty aware of the biggest news in May that was not the halving. And it was Paul Tudor Jones announcing that he had made an allocation to Bitcoin. And for those unfamiliar with Paul Tudor Jones, he's a legendary macro investor. And he wrote this letter to investors last month called The Great Monetary Inflation, where he kind of described some of the unorthodox economic policies that we're seeing and how that's caused him to adapt his investment strategy. You kind of see on the right side of the page monetary stimulus from some of the central banks around the world. And why are these central banks basically printing all this money? So take the United States for an example. You have an economy that is historically indebted, and you have a federal government that has increased spending needs to combat the effects of the coronavirus as incomes have collapsed with global lockdowns, and a domestic and international lender base that cannot absorb all the new treasury issuance that the United States is issuing. So what that means is that the Federal Reserve and many central banks around the world similarly have to step in as a kind of like a buyer last resort for all these new sovereign debt securities and kind of monetizing them. So why does this matter? Because I think the big picture here is that while people can debate endlessly about whether or not this causes inflation or deflation, the idea is that the range of potential outcomes has broadened and inflation is now on the table. And as an investor, you have to think about how to hedge out that risk of inflation. And for some, they think that Bitcoin fits the bill and offers a very attractive risk reward in that scenario. So what happens when institutions come? Institutions are kind of this white whale of cryptocurrency. Everyone's been talking about how the herd is going to come since 2017. What does it mean when they come? And it's for good reason that people always talk about and they get excited about institutions, because they are by and large the largest allocators of capital in the world. And you kind of see a breakdown of different select institutional investors, how much money they manage globally, and what it could potentially look like if this group of investors, like Paul Tudor Jones, allocated a single-digit percentage of AUM to the asset class. Very illustrative, but it kind of gives you a mental model of how to think about just how much money is out there and what this can potentially do. So what does this mean, I guess, within the broader picture for Bitcoin? So on this chart, you have Bitcoin divided into 4 periods divided by the halvings. And while we can, it's debatable about the impact of halvings on the price of Bitcoin. I think it is a good benchmark to separate different kind of like epochs of Bitcoin. And in the beginning, it was just early adopters who valued this thing and saw its potential when pretty much Bitcoin was valueless, and then moved on to early adopters who recognized the potential for a non-sovereign money. And then it went to retail, whose imaginations were captured by the ICO boom and the promises of decentralized technologies. And I guess the question from here on out is will this next epoch be defined by institutions? Will this be the epoch when institutions finally step into the game? And it's definitely unclear. You never really know if and when they will come or if they'll ever come, but the backdrop is potentially as attractive as ever. You have inflation potentially back on the table, which investors are looking to hedge out. You have rising geopolitical tensions, rising social tensions, and you also have declining trust in institutions, which makes decentralized technologies as attractive as ever. So with that, I see I'm getting kicked off the stage.
It's a soft hook because I took a couple minutes for you. So finish the thought.
No, it's good. I mean, that was it.
I thought you were right on time. So
yeah, right on time.
Perfect. So you're not getting. I can't fire you. I can't fire you. You quit. Please don't do that. Ryan Watkins, fantastic presentation. Thank you very much.